And as a result, billions of dollars of deposits have basically been frozen.
There's a lot of anxiety right now, a lot of panic going on.
This is basically a Lehman-sized event for Silicon Valley.
It torches years of US innovation, and you should not let that happen.
And so what has to happen, the only way this can happen, is if someone takes over Silicon Valley Bank this weekend.
The basic problem that we have right now is in the last 36 hours, a key part of the financial plumbing of Silicon Valley has basically been turned off. And as a result, billions of dollars of deposits have basically been frozen. It means that people can't pay their bills. It means that people can't access their deposits. It means that credit lines could be in default. It means that payroll can't be met. And so as a result, we have this potential contagion on our hands. But in order to understand it and unpack it, I think it's important to explain exactly how this came to pass. So let me just hand the ball to Freeberg, and then we can talk about some of the implications, of which there are many.
The irony is, it really was and is, prior to the quote run, a financially solvent business. But if you look at their balance sheet, Silicon Valley Bank at the end of the year had about $195 billion in liabilities, $173 billion of customer deposits that they owe to customers and $22 billion of other debt. And then they take those customer deposits and they invest it in a number of securities. And the way that a balance sheet business like this bank would operate is, the customers have access to their cash anytime they want. But in order for the bank to make money, they make longer duration investments. And those longer duration investments give them the ability to earn money on those longer duration investments more than they're paying the customers for the deposit. So if you look at their longer duration investments, they had about $208 billion of total assets sitting on the balance sheet. And remember, if you go back to the beginning, they only had $15 billion of true net book value, which is the difference between their assets and their liabilities. And so if you really start to adjust, what are those assets really worth? Are they really worth what they're holding them at the book at? And if people start to pull money out and you got to sell them at a distressed price in order to give people their cash that they're owed on deposits, that's when you have a classic run on the bank problem. And then everyone tries to be the first out the door. And that's basically like what triggered this week.
Okay.
And I think that this is right up there, could be 2, probably 3, in terms of the level of panic and concern. The problem is we're in the middle of it. We don't know what's going to happen this weekend. So there's a lot of anxiety right now, a lot of panic going on, and a lot of, unlike COVID and 2008, really acute effects that many companies and investors are actively dealing with right now. Not just a few, thousands of companies that are really in a state of distress right now. So it is potentially, from a Silicon Valley perspective, worse than 2008 or COVID.
Oh, for sure. For sure. I mean, this is basically a Lehman-sized event for Silicon Valley. Remember when Lehman Brothers basically filed for bankruptcy in 2008, started the whole financial crisis. The federal authorities thought that the best plan for Lehman was to file for bankruptcy. They didn't try to save it. And that basically led to a cascade where the whole financial system almost collapsed. I think that SVB, this is a Lehman-sized event for Silicon Valley. And there's 2 big things happening. One is the impact on the startup ecosystem. So you're seeing probably thousands of companies now cannot make payroll in the next few weeks because their money is trapped and tied up at Silicon Valley Bank, which is now under receivership. So if you wired your money out yesterday, you're good. And a lot of people managed to do that, but there are a lot of people who had wires in the hopper, didn't make it. Today, logged into the website, can't log in, their money's just frozen. And we don't know when they're gonna be able to get their money out or how many cents on the dollar they're gonna get. So basically the whole startup ecosystem is in peril. I think Gary Tan called it an
extinction level event.
Yes, exactly. That was a good term. And just to be really clear, this is not big tech at risk. I know there's a lot of people out there who don't like the idea of bailing out big tech.
This is not Google. It's not Amazon.
Exactly. Those companies have plenty of cash. They're fine. This is small companies with 10 to 100 employees. And you're looking at maybe thousands of them just being wiped out for no reason. They didn't do anything wrong because of this. This could have a very damaging effect on the startup economy and the whole United States economy. This is little tech. These are the future companies that will keep the United States competitive versus China and the rest of the world. And then the other big thing that's happening, and this all happening in real time, is a regional banking crisis. Because when depositors see that their money was not safe at SVB, which was a top 20 bank that, as far as everyone knows, was in regulatory compliance. Nobody has said that SVB wasn't compliant. As far as we know, they had a regulator's seal of approval. And now you find out your money was not safe and it's not FDIC insured above $250,000. So the conversations we're all seeing in our chat groups with leading investors is, why the hell would you keep your money anywhere but JP Morgan or a top 4 bank? And so I think that unless the Fed steps in here over the weekend, we're going to see potentially a run on the regional banking system, a cascade like we saw in 2008.
U.S. Treasuries were at 102. You get like a 2% a year. They bought a bunch of those. That was actually, when you think about it, you would say that's a safe bet. The problem is those are locked up for 10 years. And nobody anticipated on the Silicon Valley Bank team that the rate hike would happen so quickly, so violently. Remember, we saw the 25, 25, 50, 50, 75, 75, all those increases. Now, what happens to a 2% U.S. Treasury when the interest rate goes up is they get devalued. They're not worth as much. So if you did need to sell them, you would have to sell them at a discount. If you held them to maturity, you would get that complete return. And what happened here is they needed to sell these early, and they sold them early, and they took a massive loss, billions of dollars, and that's what lit the fuse.
Now, why in that meeting did they have to decide to emergency sell? It's because VCs stopped giving startups money, so startups couldn't deposit more money into the bank, but they kept spending at the same rate that they were spending.
In other words, means that the deposits went down. Yeah.
In the last 18 months, not enough folks read the memo.
Mm-hmm. Yes.
And by the way, the tragedy of that is, let's just say that you did get the memo and you did make the hard cuts right now. And let's say you're working on something and you can fill in the blank on the thing that you care about. Okay. So for the listeners, let's say it's climate change. Let's say it's breast cancer research, whatever it is. This had nothing to do with you 4 days ago. You had your money in the bank. You did everything you needed to do to go and, figure out product market fit, try to get to market, try to sell your product. And all of a sudden, because of some other set of folks and actors who couldn't get their act together, now you're on the precipice of bankruptcy in 36, 48 hours. That's crazy to me.
The California regulators stepped in and they froze everything. So our companies were in the process. We have companies that submitted a wire yesterday. By the way, we spent all day yesterday on the phone with our portfolio companies trying to get them out. We had wire requests that went in before the deadline, and for some reason, we're in a queue.
They didn't get through.
And they didn't get out. They didn't get through. And then the California regulator steps in this morning and freezes everything. And what did they announce? They said, oh, you're good for your insured amounts. How much is that? $250,000. For your uninsured amounts, which is everything above $250,000, you're going to get a certificate. A certificate? What does that mean? That means you're a creditor in bankruptcy. So the mutual fund that you thought you owned was actually not hypothecated in your name. It was in SVB's name at BlackRock. And so our companies have been calling BlackRock and calling Morgan Stanley saying, hey, do you have my money market fund? And they're like, no, sorry, that's SVB. So
this
now
is the crazy
they're
thing.
Sitting in a creditor line in bankruptcy.
We got to explain this. These were called sweep accounts. So what Silicon Valley Bank did with some of these large portfolio holders, let's say Saks and a bunch of other VCs gave you $30 million. Yes. And they took your money and they said, you know what, just to be safe, we're going to take your money, we'll automatically sweep it and distribute it across 2 other accounts. So we got this BlackRock over here for you, great. We got this Morgan Stanley over here, great. Whatever it is. You could only get to those through the Silicon Valley Bank interface. And so it was supposed to protect you, but there's no recourse, it seems.
Well, you have 2 paths here. Path number 1 is if you actually try to sell these assets. But the problem is, who do you think the buyer is? The buyer are the sharpest sharps on Wall Street who will purposefully underbid these assets. And so that then takes you to path 2, which is then the only other real solution is for the Fed to warehouse them and guarantee them. And that's an equivalent version of what they had to do during the Great Financial Crisis, which was this thing called TARP, which is the Troubled Asset Relief Plan. It was just a backstop and a mechanism so that these, at the time, those toxic assets, which were a bunch of mortgage-backed loans, could be cleared through the system over time, which effectively meant that the Fed basically warehoused that risk. So I think what we need to see now is Sachs, it could be 50 cents on the dollar. It could be 60 cents if you want immediate liquidity. You know, a friend in our group chat was mentioning that there was one claim, a company that had $100 million inside of SVB was offered 60 cents on the dollar today for that claim. Now, that's from a third party who said,
Wow.
I will give you 60 million today in return for that certificate plus the 250,000 that says you're owed 100 million, because they're willing to take the risk that they'll get, 80 million,
Wow.
right? And then they take the difference. Now, the point is that if you're seeing today that kind of a discount, that's not a good sign, I think. And it does speak to the fact that regulators have to step in. Now, here's the other reason why I think it's important. I think what regulators, and I think the people, and there's a lot of them in Washington that listen to this, what this does is it torches years of US innovation. And you should not let that happen. There are companies working on really important things for the United States and for the rest of the world. And if the company fails because they can't make the product work, so be it. We take that risk every day. If the company fails because customers don't want to buy it, so be it. If the product fails because a better product comes out, so be it. But it shouldn't fail because we can't get money that is
because you forgot your PIN code.
Deposit.
Yeah.
That should not be why we torch hundreds of startups and what they're working on.
And so what has to happen, the only way this can happen, is if someone takes over Silicon Valley Bank this weekend, and that the federal government, unfortunately, as much as I hate to say it, because I absolutely hate the federal government having a role in this stuff, has to say, we will guarantee 100% of those deposits to the company that takes over, the bank that takes over this portfolio, and says, let the portfolio of assets run its lifetime, see what you get paid, whatever the delta is, we'll make it up to you. But we need to make sure that there's cash here today for all of these depositors to get paid tomorrow.